everyone. Welcome back to ISC Studios Coffee with Scott. Woo! I am going to be your hostess today. My name is Ashley Ayler. I am an intern here at ISC. And today we are going to talk about a little bit about the inverted yield curves and, the economic analysis behind what it is and what our economy is going through right now. So, Scott, can we just learn about what a yield curve even is?
Sure. Yeah, that's a good question. The yield curve is essentially a graphical representation of different bonds at different maturities and what interest rate they're paying.
Okay.
So there are three types of yield curves. There's a regular sloping yield curve, a flat yield curve, and an inverted yield curve that you mentioned that we're in right now.
Right.
In a normal sloping yield curve, you're paid more for longer dated bonds than you are short bonds because of uncertainty over time, interest rate volatility, and so forth.
Right.
That it makes sense that you'd be paid more to own a 10-year bond than a 1-year bond, for example.
Right.
The situation we're in today is the opposite of that. It's inverted. You're paid more for holding short-term bonds than you are long-term bonds.
Yeah.
And so the yield curve is therefore sloped negatively.
Yeah. So why do we think that why are we in this kind of predicament?
Well, the yield curve's inverted on the short end because it's pegged to the federal funds target rate of interest, which they've been raising rates aggressively. We know that we had a lot of inflation in the last couple of years. Mm-hmm. So they've raised that discount rate, which is the rate that banks can borrow and lend to each other at, up to a range of 5.25% to 5.5%. And so they pretty much peg and control the short end of the yield curve. But the longer dated bonds are predicated on just market forces, right? The investors, pension funds, and so forth that are buying and selling bonds kind of dictate the longer end of the curve. So it tends to float up and down.
Yeah. So is it a bad thing? Is it a good thing?
Well,
what do investors think an inverted yield curve is for their portfolios?
Historically, an inverted yield curve has been a pretty solid predictor of coming recession. In fact, I believe it's pegged 8 out of the 8 last recessions that we've had as an economy.
Yeah.
So it's not that the yield curve necessarily causes the recession, but it's kind of a symptom. Like when you have a fever, that's not what makes you sick, but it's telling you something's wrong in your body, possibly.
Right, exactly. So then what should investors be doing then in this type of economy with, inverted yield curves?
Sure. Well, a lot of people are putting a lot of money into things like CDs and money market accounts because for the first time in a long time, you're able to make a real return net of inflation, right? So if inflation is running 3, you're making 5, even more on short-term bonds. You're actually growing your assets without having to take traditional investment risk.
Right.
What we recommend you do is, while that's all said and good, you should also probably look at having some duration in your portfolios, meaning that you just don't want to buy only the short-dated bonds.
Yeah.
But it's called like a barbell approach, where you have some very short-dated bonds and some long-dated bonds.
Yeah.
Because if interest rates go down on the long end of the curve, then you can get that coupon plus some appreciation in the price of those bonds.
Right. And so why is it important to stay informed about these type of economic indicators?
Yeah, because interest rates really are the driver in a lot of ways of earnings for corporations, particularly more growth-oriented stocks where maybe they're not making a lot of money today, but the market anticipates they're going to have these big cash flows and earnings way down the road.
Right.
And interest rates kind of dictate what the discount rate is. So you take those future cash flows and you discount them back to today based on a risk-free rate of return, as you're probably learning in your math classes at Baylor, if I had to guess. And so the higher that discount rate is, the less those future cash flows matter to a company, and therefore the less their valuations matter. So it can be a big participant in stock market returns, what the rates of interest are.
And so in today's economy, what is it looking like?
Yeah, it's a great question. So the yield curve has been inverted now, I believe, for 23 months in a row, which is unprecedented.
Yeah.
And, as I said, historically, that's been a driver of recessions, or it's been a factor, in a coming recession. This time it's looking like the Fed, they've been very careful to try and raise rates enough to where they're restrictive, but not so high that they choke off the economy.
Right.
And so we're kind of shooting for this Goldilocks-like landing where, it's a soft landing is what they're calling it. And, so far it looks like they've avoided, really driving the economy into recession, which is good news.
Yeah. That makes sense. So what do you think is going to happen for the future? Like, what do you predict?
So the Fed last week came out and they predicted, based on data, they're very data driven, but they're kind of anticipating one rate cut this year. The bond market, it's just the collective, investors in the bond market are saying there's a 70% chance of 2 rate cuts this year. Okay. So somewhere between 1 and 2. They hope, the FOMC, the Federal Open Market Committee, long-term forecast is to have the short-term rate down around 3.5% again in the next 2 to 3 years, which I think is probably reasonable.
Yeah. Obviously, we talked a little bit about, the causes and understanding investment behavior. What should these viewers, get as key points, watching this video?
Yeah, I think, ultimately the rate of interest is just one variable that has to factor into your decision-making process. It's an important variable, but it is just one. And we always recommend that our investors take a long-term approach to saving and investing and let that drive their decision-making more than any variable like interest rates.
Yeah. Thank you so much for listening. Make sure to subscribe and like if you were intrigued by this video, and we'll catch you next month.